Hi everyone, how did we get where we are right now with the real estate market? And where do we think it's going? Hi, Joe Kehrig with the Kehrig Real Estate Team. And you know, this is kind of a funny market for a lot of people, and I'll tell you why. Is because it's pretty clear that the correction that we went through was because of the mortgage rates going up. So it's really important to look at, which we will today, where we expect the interest rates to go since they affect the real estate market so much, and where do we expect prices to go based on the mortgage rates. You know what's so weird about this market right now is the fact that, you know, the interest rates are going up, which is softening the market and stabilizing the market, and we went through a correction a few months ago of probably about 10 to 20% depending on where you are in the San Ramon Valley. But here's the interesting thing, is the fact that we have so much inflation, and that's why the Fed's talking about now their third straight month of 0.75% increases, which is kind of tanking the stock market. And the inflation numbers just came out and they weren't that great. Inflation was still high. So, you know, you look at the real estate market, and it's always been the case that real estate is the best hedge against inflation. So you want to sit there and go, okay, you want to own real estate. Why the inflation is high? Because as prices go up, the real estate prices go up. But what we're seeing is with runaway inflation, and now going into the seventh recession that I've sold through, we have the interest rates going up, and that's what they do. And interest rates rise when you go into a recession to try to trim it back for the soft landing. But yet what happens is, and then interest rates go down when they try to take us out of the recession. So we're kind of in a quandary right now. Interest rates have gone up, prices have softened, but yet with runaway inflation, prices of homes should be continuing to go up. As we've shown you before, the last 6 recessions, in 4 of those recessions, prices have gone up. One, they stayed about the same, and then of course we have the Great Recession of 2008, that the prices basically tanked 20 to 40%. So let's look at where we expect interest rates to go, since they dictate so much the real estate prices, or at least they have the last 2 years. As interest rates went down, prices went up, interest rates went up, and now we've got the softening of the prices. You know, look at the mortgage rate projections from Freddie Mac, Fannie Mae, the Mortgage Bankers Association, NAR, National Association of Realtors, and you can see from being 5.35%, maybe a tad more right now, they expect it actually to stay the same or drop over the first 3 quarters a year from now in 2023. So if mortgage rates do stay somewhat stable, I think you can expect the prices to stay stable. You can see the mortgage rates where they're going. Look at from January 2008, how they basically were up close to 5%, and then obviously, you know, they dipped way down in the 2.5%, 3%, then went back up, and you know, you can kind of see they're showing some stabilization of the interest rates, which we're anticipating will stabilize the market. And of course, with interest rates going up, look at this month's inventory of homes for sale since 2019, and they've almost kind of driven by, when you look at the mortgage rates. If I overlap these graphs of the mortgage rates and the month's inventory of homes for sale, you'll see that they kind of match. You know, basically the inventory of homes for sale was up, and then it dipped way down when interest rates went down, and now it's gone up again now that interest rates have risen. So really, and the more homes that are on the market, the longer they stay on the market, and prices will soften a little bit more. So prices of homes do have a direct correlation to what's going on with the interest rate. That's why it's so important. That's why when we talk every week, where we expect the mortgage rates to go. We'll probably certainly see them go up a little bit more. Maybe, you know, they've been hitting right at 6%. They maybe might go a little bit more, but then I think you can expect to see them pull back a little bit. But again, inflation is really the key to that, because as long as they keep printing money, really what they're doing is they're raising the interest rates. It's kind of like trying to keep a boat afloat, and they keep bailing it out, which is what they're doing by raising the interest rates, but they're not dealing with the hole in the boat that's letting the water in, and that's basically the spending that they're doing in Washington. You know, so they have to figure that out, because they can't raise the interest rates out of you know what they're in right now. They have to obviously quit spending the money to keep the rates down. You can see the month's inventory of homes for sale just the last 12 months, and we've seen that dip, and then we've seen it going up, and you see the year-over-year inventory levels. See, this is what we talked about a couple weeks ago. You know, it's basically the inventory's been down. Red is obviously where it's way down, and then you saw actually when we went through the correction, the inventory went up, and now it's basically, for June, it was like 0%, which means it was almost exactly even. So we've actually seen a little bit of pullback and a little bit of good news if you're a seller, and we'll see that when we look at the graphs, you know, for the area. And you see the year-over-year change in price. They were forecasting currently, it's about 16%. Last month it was actually 8% year-over-year, and they're forecasting 3.8%. So they know that prices are going to settle down, and basically they've already stabilized, and they expect them to basically stay fairly stable for the next year. Now let's look at the market, and you'll see exactly what I'm talking about. Because here's what happened. You know, during the correction, you know, 3 months ago, we had basically the active listings were here and the pending listings were here. So we literally saw a complete invert, where active listings, there was twice as many pendings as there was active properties, which obviously is a huge seller's market. And then we saw it go to, there were twice as many listings as there were pendings. But here's what we've seen the last 6 weeks. We've actually seen, because the reason for that is when they raised the interest rates was at the beginning of the summer, where we get a lot of new listings coming on. So it was like a double whammy as far as the market getting hit. Now as we get towards the end of the summer, you see what's happening. Look at the San Ramon market. You know, the actives the last 6 weeks have gone down and down and down. Now pending sales dipped down a little bit in San Ramon, but when you look at other areas, look at Danville. Again, the pending sales have stayed fairly stable, activity down, down, down. If I showed you the last 6 weeks, you'd completely see 6 weeks straight of inventory going down, not rising, and you'll see pending properties either going up or right now they've kind of stabilized. Same thing when you look at Blackhawk. Pending sales have stayed pretty stable. Active properties have basically gone down, down, down the last couple of weeks. Alamo is a complete mirror image of that. Completely the same, where active properties have gone down, pending properties have stayed the same. And then Dublin, you've seen active properties go down, and the pending sales have actually gone down a little bit. So what you basically have throughout all the areas is the active properties are going down, because now we're getting in the time of year where not as many people are putting their homes on the market, and so active properties are going down. The key to it, those pendings are still staying fairly stable. So we're really seeing, we basically saw an out of control market, then we saw a correction, now we've seen a stabilization, and it's kind of finding its sea legs a little bit. And then when we look at sold, the list price percentage, you know, Dublin dipped a little bit over 100%, but for the most part, they're 95 to 98%. Now, this doesn't, as I always tell you every week, this doesn't come into play. This doesn't count the price reductions. We'd probably be down at 90% if it counted where a property ended up and where it ended up selling at. Because as I mentioned before, if a property is $2 million and they lower it to $1.8 million and it sells for $1.8 million, that's going to say it sold for 100% of asking. In reality, it really sold at 90% of asking where they started. Looking at the hot sheets every morning where it tells me the active, pending, or sold, we're seeing a fair amount of pending properties. The active properties are staying pretty consistent. Still seeing a lot of price reductions come on the market. So, you know, the market's a little squirrely out there, but for the most part, if someone asks me where the market is, it's stable. If they ask me, hey, what should I do if I was a seller? Well, you know, number one is if you're a seller and if your plan is to move in the next year or so, then we should be having a conversation. You should reach out, we'll sit down, we'll figure out what your game plan, because there's only 3 things, as I always talk about, that can happen with prices. They can go up, they can go down, they can stay the same. You'll have probably 50% of the people that think prices are going to continue to go down, even though they've kind of stabilized. You'll have another 40% of the people that thinks for the most part it will stay stable. That's kind of where I'm at. And then you have 10% of the people that actually think prices are going to go up. There's not a lot of people with what we're going into, the uncertainty and the economics and the inflation and the rising interest rate, that thinks the prices are going to go up. So if you're thinking about selling in the next year or two, Now, you should really think about it now. Maybe you don't make that decision. Again, I would not sell and put your money in a mattress. I would sell and go find another real estate investment someplace else. Having said that, unless you have a reason to sell, you probably shouldn't be selling either, because with the cost of selling and the cost of buying, just deciding to move, you might have an interest rate at 2.5% to 3.5%, where you're going to be looking at 5.5% to 6%. So if there's a purpose, a plan behind your move, give us a call and we can sit down and walk you through it, decide if it really is the right thing for you to sell. If you're a buyer, I would definitely be in this market, and I'll tell you why. Because interest rates are certainly probably going to go up a little bit before they settle down. Plus, people will go, I want to wait a couple months. Well, if you wait a couple months, two things that you're looking at. One is the fact that interest rates are probably going to be a little bit higher. So even if you get something a little bit less, your cost is going to be the same. But let me tell you the other thing people don't think about is right now we have a fair amount of inventory on the market. By the time we get to October, November, December, even if prices back off a little bit, you're going to be buying the stuff that no one else wanted. I always refer to it as a sales rack in the store. You're going to get, what's going to be left is all the stuff that no one else wanted. So again, every situation's a little bit different. You really need to sit down and talk to a real estate professional and make sure you have a good plan in place, because this is a great time to be a seller and a buyer, again, depending on what your long-term plans are. If you want to sit down and chat a little bit more about it, give me a call. Again, Joe Kehrig with the Kehrig Real Estate Team, cell number 925-487-6838, or drop me an email, joe@kehrigteam.com, or visit our website, www.kehrigteam.com, to take a look at all of our listings, and you can learn a little bit more about the Kehrig team. Well, make sure you tune in, subscribe, because we'll be giving you weekly updates, because this market is very fluid, and Federal Reserve is going to come out and up the interest rate now for another 0.75%, and so we'll see what happens with the market there. I'll keep you up to date, let you know where we're going. Thanks for tuning in, and we'll see you next week.